Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us. All right, let's get across what's going on at a macro level. And US consumer prices, well, they increased more than expected in September, driven by higher costs for fuel and rent. However, underlying inflation is slowing. The consumer price index increasing 0.4% last month to be up 3.7% for the 12 months through to September. Excluding food and energy components, core inflation rose 0.3% for the month to be up 4.1% year on year. Meanwhile, jobless claims were unchanged at a seasonally adjusted 209,000 last week in the US, which was almost in line with forecasts, with no sign the auto union strike, now in its fourth week, is having a major impact on the labour market there. Well, that inflation data saw US Treasury yields advance on expectations that the Fed could raise interest rates one more time this year, while an auction of 30-year bonds was met with poor demand, helping to send those yields higher. The US 10-year yield was up 10 basis points to almost a touch 4.7%, and the 2-year rising to 5.06%. And the US dollar rose sharply after the release of the data showing US consumer prices there rose more than expected. The Aussie dollar tumbling down more than 1.5% to trade at 63.1 US cents. Well, to get across the impact of that data, plus a closer look at what's going on with US equities, particularly in the tech sector, ahead of earnings season, which officially kicks off tomorrow, I caught up with Brad Gastwirth from Unearthing Opportunities.
The economic data has been a little bit inconsistent as of late. We've had some recent findings of a slowdown, then we had a little spike up a couple months ago. We're still in that teeter-tottering point where it's still unclear how much higher it's going to be going from when you use all the different economic factors. But if you look at just the companies and what they're doing with their actual prices continue to go higher. Chipotle announced another price hike. This comes after the last. Disney just increased prices, or just announced they will be increasing prices at their parks. If I go shopping, it seems like everything's a little bit more expensive just from a quarter or two ago. So, I mean, the consumers are seeing the inflation. Some of the economic data is skewed a little bit by also what oil and other things that go into the reading, but inflation is still a big deal and something we have to pay attention to on a daily basis.
Yeah, you mentioned Chipotle there, as we can see its stock price. Another company doing the same thing, Pepsi. In fact, we got its results earlier in the week, just reflecting what those companies are doing at the moment.
Yeah, I mean, when the input costs, and some of these input costs actually aren't going up that much, but the input costs went up, but yet these companies are continuously raising prices even after the plateau of that input cost. So, I mean, you're getting these food retailers, and a lot of these fast food companies have raised prices pretty dramatically. And if you look at some of these stores, and if you look at consumer behaviors, the spending on food and retail, it's still quite high, but it's starting to slow down a bit. And I think it's because of the prices have just gotten a little bit too high. But I mean, for these fast food outlets like a Chipotle, higher prices mean higher profits. So I mean, it's a net positive for those companies, and that's why you see stocks going higher when they announce these price hikes.
Brad, overall, as we enter third quarter earnings season, what are your expectations there? I guess particularly with the focus on what you're seeing with tech.
Yeah, and so there's still a lot of cross currents with tech. If I break it down on the semiconductor side, we're still seeing a pretty awful environment, and you're having really driven by the lackluster sales in smartphones. I mean, smartphones obviously are the largest unit driver for semiconductors. So with the slowdown over in China and what's happening at China on a macro level, it's having a major impact on semis. If I now move across areas and go into the AI and software AI, it's booming. I mean, Microsoft raising prices on their suite because they include AI. That's going to have a major impact on profitability in the out quarters in this Q3 timeframe. We're still seeing the AI related companies perform well. I think one of the issues we had with Q3 is that stocks got ahead of themselves and expectations got rather high. But that being said, the software related are still performing. I think the hardware side, we're seeing some more speed bumps on the way. I think it's a cross current there, but ultimately with tech, I mean, the biggest crossfire now is with the war over in the Middle East, and how is that going to impact behaviors on either consumer side or enterprise side? And right now, we're not seeing any major impact on either of those levels from different overseas areas, but that's something we certainly have to watch.
Just stock specifically there, Brad, with a reference to Microsoft. Interesting news there with the IRS saying it may owe $29 billion in back taxes.
Yeah, Andrew, when I read that initially, I thought I misread it. I thought it was a decimal point off, but no, it's almost $30 billion. The IRS is saying that Microsoft has sort of, has not paid in in taxes, and they've gone through different tax strategies to not pay that money. The stock shook it off. I mean, it wasn't even down 1% on that news. I would have actually expected a little bit more prior to that, but the company's executing at such a high level on the software side and in regular fundamentals that I think the investors are one, they're not believing that they'll have to owe that much money. Ultimately, probably settle at a fraction of that amount, and a fraction of that amount doesn't move the needle at all for that behemoth. So Microsoft, yes, that's still a large. And moving on to other areas to that question, Andrew, I still like a lot of these software AI related companies. So an Adobe, a Salesforce.com, and then on the mega cap, Amazon remains my favorite on the large.
Okay, so they're the ones you're saying you must have in your portfolio.
Absolutely. And in tech, if you have tech exposure in the US, you have to have those three companies.
All right. What are you seeing with Samsung at the moment with a falling profit there? Is there signs of further trouble ahead for Samsung, do you think?
Yeah, and it's a good question to bring up, Andrew. So I mean, that goes into that my first comment on the semiconductors for Q3. We're seeing a hit in that sector, and they're seeing an industry-wide slowdown was the words that they used, and that's not very far off from what I'm picking up from my checks across globally on the semiconductor side. Now, Samsung also has a big part in memory, and on the memory side, prices have fallen dramatically. Now, some will argue that prices have now hit a bottom. I think we're probably very close to a bottom. I think we still could go further for memory pricing. But when you're down 80% of profits year over year, we're getting close. And I don't think we're at a turnaround just yet. But you have to start looking at it from a valuation side. It doesn't make sense. But there's still a lot of crosshairs in semis. I don't think we're there. We have to have the upcycle in smartphones, and we're not there yet on that side either.
Brad, let's turn to Tesla. Looks as though it's engaged in a race to the bottom at the moment, just as far as its pricing is concerned. What are you seeing there? What's at play?
Yeah, I feel like it's every fortnight we have this conversation. It's either another price cut, or there's something in the news with that company. Tesla's cut prices so many times this year. It's a little alarming from a financial analysis perspective, because typically you cut prices to spur demand, and if you're cutting prices, and then also if you look at that recent Q3 delivery number, that was light also. So they missed Q3 deliveries. They cut prices again. It to me is a troublesome sign. I think that, we've had a dramatic increase. If you look at year over year in terms of overall production, they've executed incredibly well, but we've gotten ahead of ourselves in terms of expectations and in terms of valuation. So I'm still not a buyer of Tesla. I think this is troublesome news. And I think when you see price cuts, you see margin cuts. And I mentioned that last time, or I've mentioned this many times on your program, and the last few quarters of margins have gotten hit. So price cuts mean margin decline. So investors have to expect that for that company.
Brad, of course, the problem is competing with China and those brands coming out of there, and the power that they have with their pricing at the moment. It's going to be difficult for those EV companies outside of China to compete.
Absolutely. And I mean, so Tesla has this unique advantage of being known as like the high-end electric vehicle maker, right? They're still expecting, or they're still seen, especially in the China, in China specifically, they're seen as the one of the high-end providers. So they'll do well from that upper middle class market. And if you look at the numbers, their upper middle class is bigger than the U.S. by itself. So they still have a big market to sell into. But yeah, I mean, if you're looking at that middle segment, that's the the largest part of growth. They can't compete. I mean, and China's always been one that goes down to nothing in terms of margins, and any other company is going to get killed. And that you nailed it on the head, and it's exactly right. I think companies that are competing on price alone don't stand a chance to Chinese companies.
All right, Brad, let's round it out with the other big news stock-wise this week, Birkenstock floating. It is a sandal company after all, not a tech company, and a lot of questions about its valuation.
Yeah, I mean, it priced at $46 a share. It closed almost 15%, or I guess it was like 13% below the offering price. That's never a good sign. I mean, you've had LVMH owned a big chunk of it. They sold a big chunk, but for almost 9 billion valuation, I was hearing rumblings earlier when they were trying to price it that there was issues. I'm not surprised by this. I'm surprised it got that high a valuation at the sell. So they did get that $46, almost a little over 8.5 billion valuation for the company. To me, that was too high. The stock reflected on it. It's never a good thing, especially if you look at IPO markets in general. When you have like highly anticipated, it's almost a mid cap, almost 10 billion company that sells off on trading day is never a good sign. So we'll see. Does that deter other people from coming to market or other private companies? I don't think just yet, but certainly was a little bit of a black eye.
Brad Gastwirth from Unearthing Opportunities. That is the global view. Stay with us. The Open, just a couple of minutes away.